Hello, chart watchers, and welcome to this Monday, July 30th Market Watchers Live show with your hosts, Tom Bowley and Mary Ellen McGonagle. Aaron Swinlin will be joining us again on Wednesday. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we're starting a new week, and you can see the Dow Jones Industrial Average under a little bit of pressure, down 63 points. The S&P 500 down 11. The NASDAQ again taking the brunt of the selling, down another 80 points today. The Russell 2000 actually hanging in and is flat for the day. 10-year Treasury yield, after moving up earlier today to 2.99%, is now backed off a little bit, currently at 2.97%. Volatility index picked up on Friday and kind of picking back up again today as it moves closer to the 14 level. Energy performing extremely well today as crude oil prices move back up above $70 a barrel. The XLE is up about 0.75%. Technology, as you might imagine, with the NASDAQ struggling, technology, the leader to the downside, down close to 1.5% today. Facebook, the selling that started Thursday of last week, is continuing today. Facebook down another $6.50 to 168. Electronic Arts, Adobe, and Netflix, three big names on the NASDAQ 100. These stocks are definitely contributing to the relative weakness that we're seeing in technology and in the NASDAQ in general. All right, well, it is a new trading week, and at least for today and tomorrow, I have a new co-host with me, Mary Ellen McGonagle. Mary Ellen, it is awesome having you on the show.
Oh my gosh, it's so exciting and wonderful to be here. I've watched your show, and it's always so informative and delightful, and I'm happy to be able to be a part of it for a couple of days here.
Yeah, you were on the show once before, and I don't remember what for some reason I wasn't here. I'm sure it had something to do with golf. That would be
I was, and that was a great experience as well. And it was an opportunity to introduce my work. I, of course, am part of the Top Advisors Corner, where I write some timely articles, and then more recently now with the MEM Edge show. So really enjoying immersing myself in all things stock charts. It's a wonderful, wonderful world.
And your show comes on once a week, is that right?
It does. It's Monday morning, and in fact, I wrapped that about an hour ago. So it's from 10:30 on the East Coast time for 30 minutes, and it's all about where the movement is in the markets, where the momentum is, and where you can find stocks and groups that are poised to outperform. So it's a very interesting period in the markets, I'll say that.
Yeah, no doubt about it. Well, we have some interesting markets, and we're got a great show for everybody today. And I'm excited to have Mary Ellen join me today because I did out the last time that she was with the Market Watchers Live. We've got the August seasonality report coming up tomorrow. So that'll be interesting. I'll give you the latest on what at least you might look for in the month of August. Doesn't mean we'll see it, but we'll talk about tendencies. And then later in the week, we got Bruce Fraser coming on, and unbelievable, Mary Ellen, you're going to be there. ChartCon starts on August 10th.
So excited. Yes, that is going to be just a wonderful event. The lineup is stellar, and I can only tell you that the subject matter could not be more timely. So it's going to be great.
Yeah, and I can only imagine what the discussions are going to be like with a bunch of technical analysts getting together. I don't know how many of us there are. I've lost track, but there are, like, as you said, it is a stellar lineup. I'm looking forward to it.
Yeah.
Let's talk about today's agenda, though. We got Monday setups. Too bad Erin's not here today because she could gloat a little bit. I think she's got me cornered for the past week. But we'll get some picks from Mary Ellen later in the show, so that'll be interesting and exciting. Then we'll do the earnings spotlight. No John Hopkins today, but Mary Ellen and I will take a little different approach, taking a look at some companies that reported last week. We'll get into the 10 in 10. First stock today will be Take-Two Interactive. Because Aaron is not in, we're going to do things a little bit different today. So we've already got the 10 stocks selected. Just wanted to let you know so you're not too frustrated if you type your questions in and they don't get selected. I did already pick the 10 stocks, some of which I think will be very interesting, and we'll take a look at those later in the show. And then finally, we're going to wrap up today with Are You Buying This? This is a segment where Mary Ellen and I will kind of pose a question and have a little debate back and forth, see whether or not we agree with one another. Very interesting. I think you'll find that a fascinating segment as well. So let's get started today. I'm going to get going with the technical news first and foremost. We did have one economic report out earlier today, and that was on pending home sales for the month of June. That showed that there was an increase of 0.9%. I'm showing an estimate of 0.5%, but earlier I was showing an estimate of 0.8%. So I'm not sure which one is correct, but either way, we did come up with an actual number for June pending home sales that was ahead of estimates. So that was a good thing. We did see a gap up initially in the 10-year Treasury yield, meaning that money was rotating away from the Treasury market. And we got it up close again to 3%. And just as, while we were downtrending, I kept talking about trying to get through the 20-day moving average. We finally did it and took off. Well, now we have an actual yield resistance that we're trying to get through, and that is up near 3%. That was the reaction high in the first and second weeks of June. And so that's the number that we've got to really strive for to try to get through, is that 3% level. If we do get through, what it means is money is rotating out of the bond market. And many times in the short term, that is good for equities, because as money rotates out of bonds, you're looking for a new home. Many times you do find it in the equity area. Let's talk about some of the things going on in the market today, though. Dow Jones U.S. Home Construction Index with pending home sales out. You would expect maybe there's a good move in home construction. Well, you'd be disappointed, because this group is almost flat today. It has been downtrending. So even with the good news on pending home sales today, we do continue to trade beneath the 20-day moving average. And that was after we had established a new closing low for 2018. So I'm not thinking things still look very good in home construction. I know some individual stocks in the space reported last week. I think it was D.R. Horton came out, had a really nice report. You can see the heavy volume, the move higher. We're hanging in there, but notice couldn't get through this reaction high over here at 45. That's where we failed on Friday. Got up as high as 44.58 earlier today, and we've pulled back off of that. So there's a lot still that needs to happen here for DHI to begin to resume its uptrend. And of course, it's not going to help if money is rotating away from the home construction group in general. So that is an area of the market to watch for sure. Crude oil prices up 2%. I think I mentioned that at the open. And as a result, we've got energy leading the market today. But we are getting close to overhead resistance. The XLE has struggled between 78 and 79. You can see the top back in the third, fourth week of May where we got to that level. And then just about 3 weeks ago, we hit 78, got to the lower end of this resistance area and failed, came back down. I think what we have here is just sideways consolidation off of an uptrend. I believe the XLE is going to break out, but let's not lose sight of two major components of the XLE. Between ExxonMobil and Chevron, that's about 40% of the XLE. And ExxonMobil, after moving lower with its earnings on Friday, rebounded, but we're seeing weakness today, despite crude oil prices being higher and despite the XLE leading from a sector perspective. Its largest component, Exxon, is down almost 1% today. You moved on to Chevron, CVX. CVX, and I know Aaron and I talked about this last week. Which one of these two stocks would we consider owning, given that they are such a large component of the XLE? Which one looks better technically? And Aaron and I both came up with CVX, thinking that, from a technical perspective, this looks better. I see an inverse head and shoulder here off of this uptrend. You got a left shoulder neckline. You come down here finally, put in a slightly lower low that sets the head. Inverse head, you come back up. Here's the neckline at 128. Maybe we pull back off of this. There's no guarantee that this pattern plays out. But I do think that if we pull back and then make a breakout and we get the requisite volume, higher volume, to confirm a breakout above 128, that would eventually measure up to about 136, which would be good news for the XLE. So those are a couple of individual stocks certainly to keep on your radar. Stocks that I mentioned at the open, Facebook, really getting hit again today, down almost $7, another 4%. I'm going to talk about this one later in the show on the Are You Buying This? So I'm not going to spend a whole lot of time and give away all my ammo here. But Facebook definitely under pressure. And that earnings report was abysmal last week. Again, we'll talk about that a little bit later in the show. Let's pull up Netflix. Netflix came out. Remember, they came up a little short in a couple of areas, couple key metrics. The stock gapped down a few weeks ago, 2-3 weeks ago. Heavy volume. And when it rallied, notice the prior low on this rally, we stopped right there and rolled over, and we are now attempting to put in another low on Netflix below the opening low that we saw after earnings. If we stretch this chart out from a daily to a weekly chart, what I see is higher prices and a lower PPO. So we got a negative divergence on a weekly chart. That can be very problematic if we lose the rising 20-week moving average and price support. So there was your price resistance coming across here. It looks like around 335-ish. We broke out. We're going back down. We're testing that area. We're a little bit below that 20-week moving average. I think that Netflix is at a pretty key level here in the near term. Keep in mind that the summertime, we get into August, all the way through about the third or fourth week of September. It's when the market, if it's going to struggle, it does tend to struggle seasonally, historically, during these next several weeks. So Netflix, we look at Netflix. Let me go back to that daily chart. So if we do see this breakdown and we start looking down below, I mean, then got a low around 310 that was tested, and we got another big one down perhaps at about 275 or so. Those could be another couple levels that come into play if Netflix makes this breakdown. Volume today is not light, already over 10 million shares. And we still have 35 minutes to go before the halfway part of the trading day. So it looks to me like Netflix is on pace maybe to do 20 million shares today, which would be very heavy. We don't want to see a breakdown below the open with earnings. And I'm going to pull that number up just so you have it. That was at 346.95. So we're currently trading 338. I'd like to see a recovery and print maybe a hammer today, holding on to that support level. If not, I would expect maybe some more weakness. And the way that Netflix is now trading below its declining 20-day moving average, and you can see we're just getting that death cross with the 20-day below the 50. Technically, things have changed a little bit here on Netflix. I still love the company. I think long-term it'll be fine. But short-term, as a trader, got to be careful when the momentum trades or turns against you. And I think that's exactly what we're seeing here right now. Let's take a look at the dollar a little bit and small caps, because I've talked a bunch about small caps. They are outperforming today, but it's been a rough road of late. You can see here that the dollar has been sideways consolidating. I'm not shocked by that. I'm going to pull up a chart that many of you are probably very familiar with. I continue to follow it closely, but let's take a look at the 10-year Treasury yield here in the U.S. versus Germany, because as this relationship between the two countries' Treasury yields goes higher, what we tend to see is the dollar rising. And if you go look at the correlation down here, you'll see that the correlation between these two, the difference in the U.S. Treasury yields and German Treasury yields and the dollar, that correlation tends to be extremely positive, almost always above zero. And the couple of times that it did really dip down into the negative territory, it occurred when the yields were moving up faster here in the U.S., but the dollar was declining. You can see that on all three of these situations, including the one that just occurred back in early 2018, where we got a bottom on the dollar. But the prior two have resulted in the dollar rapidly moving higher. And that's what we're beginning to see here, even though we've been consolidating. And now look at the correlation. It's back the way it normally is. So if the Treasury yields continue rising faster here in the U.S., and I'm seeing no signs of slowing down, I'm expecting the dollar to make a breakout above 95. And if that's the case, what we should see is a resumption in the Russell 2000 outperforming the S&P 500. When the dollar goes on a big move to the upside, it negatively impacts earnings on multinational companies found on the S&P 500. It doesn't have that impact on companies that only do business domestically. So normally, when the dollar is on a tear, the Russell 2000 outperforms. Now, we have seen during this consolidation money rotating away from the small caps, but I believe the dollar breaks out. I think this small cap outperformance and rally on a relative basis will continue later in the year. But I know, Mary Ellen, you and I were talking before the show, and the dollar, if it rises, it could have some other impacts, some other areas of the markets that you're watching. What do you got?
Yeah, absolutely. So I was mentioning earlier that there has been a little bit of movement in the emerging market area, and that is an area that has underperformed for most of this year, but we are seeing a pickup in some of these stocks, and the reason is twofold. The first one I'm pulling up here is India, INDA. It's an ETF that follows the Indian, the stock market there. And you can see that there's been relative outperformance here recently. And there are a couple of reasons for that. And India is specific to some of the reasoning. And that is the increased tensions with US-China and the trade war. And there's actually a backdrop thinking that India is a safe haven play. And the reason is that India is a very self-contained country as far as economically. They do most of their trading among themselves. They are not exposed to any other outside forces that might impact them. And that is one. But there are some other that are picking up. So when you say emerging markets, it's BRIC, it's Brazil, it's going to be India, China, Asia. And so let's take a look at another emerging market ETF that we can look at as an example of some of the vibrancy that is beginning to pick up. This is Brazil. Now, I will say Brazil is very wrapped up as far as with elections. There is a little bit of volatility relative to that, but you are seeing this potential reversal here of this downtrend. So what you can do from there, if you were inclined to either play the ETF, there are individual stocks within this Brazilian, these are ADRs that have recently reported. Fibria, this is a paper stock. They came out with good earnings last week. And then another is a Brazilian bank, BSBR, is Banco Santander. And this is another one that is reversing with that Brazilian EWZ ETF. And then Vanguard, VWO, they have a pretty diverse emerging market ETF. And we're not quite out of the woods yet because we still have a lot of heaviness here. This 50-day is still trending downward, but it has broken above it. So it's made its first baby step. Ideally, of course, we eventually want it to see it break back above that 200 before an emerging market ETF would be even more compelling. But the other last item to keep in mind, these BRIC countries have not really had a platform for them that allows them to freely and profitably trade. So there's another line of thinking that with the trade war tensions, that will elevate them, provide them with a platform. And they did, in fact, have a meeting last week, which really sparked some of this uptrend. But of course, Tom, you're right. The dollar, if that does escalate, that would tend to put a halt to any advance within these emerging markets. So,
yeah, I was looking actually, Mary Ellen, on this chart. I thought that was kind of interesting. Yes, we've been in an uptrend here in July, but if you go back over the past 6 months or so and have a declining tops trend line, it seems like the peak is almost right on that trend line that we've seen since back in March at those highs. So this seems like a kind of an interesting pivot area. Would you agree on whether?
Yes, I would agree with that, because you're absolutely right. If you draw a line across those tops, this is, we're just poised now to break above that and potentially reverse that downtrend.
Yeah, it looks like 44 is a big level too, because if you go back to the February low where we had all of that massive selling, we went down to 44. We we tested double bottom in May, bounced, and then we broke down below it, and now we're just coming up to that 44 level. So we got that trend line resistance, and then we also got price resistance. So it looks like VWO is at a crossroads here.
Yeah, it's certainly one to keep on your radar. And again, we do need to also keep an eye on the US dollar. And then also rising oil prices are not good for these emerging markets as well. So two potential headwinds, but worth mentioning and keeping an eye on, because they have been just so depressed year to date. And that could have been a capitulation in that late June area. If you look at all of the volume, as it really just puked out shares, and now we could potentially be turning.
Absolutely. I do want to we're going to move on to the Monday setups, but I do want to point out too that you said earlier about India. I had noticed that the Sensex index relative to the S&P 500 just broke to almost a 2-month or two-year high relative to the S&P, while the other Asian indices have been trending lower. So definitely we're seeing more money rotating toward India in that area.
Perfect.
Yep. Okay. So we've got Monday setups now. I mentioned earlier, Erin definitely took me to the cleaners this week, I think. But she had a couple. There were two setups that we had last week. Erin had HFC. Actually, I didn't look at it today, but I know last week it had a pretty good performance. She got in at 70.61. It's currently at 74.55. So Erin's not with us, but I got to, tip my hat to her. That was a great call. The stock, in a week when the market was really struggling, the stock was up more than 5%. So that is a huge win for Erin and for HFC. The stock continues to trend well. I know she likes to follow the PMO, but I've got my PPO on HFC continuing to track higher. And then WMGI was mine for the second straight week. And for the second straight week, it let me down. 25.14. I actually owned it. I did get stopped out last week. The day it was probably on it was Tuesday because it was trading down below 24.50. I went ahead and just got out. It's actually bounced back a little bit. I still think the stock looks good to me longer term, but I have pretty strict principles I like to stick by. And when it violated that, I just moved back to the sideline. So I continue to watch it. It does have excellent gap support down around 23.50 if it makes it down to there. But that was not part of my buying strategy to hold and buy when it got to 23.50. So I did exit, but I got in at 25.14. It's currently at 24.61. So that is down, 50 cents, roughly 2%. And Erin went the other way, more than 5%. So I got my butt kicked last week. No doubt about it. All right. Well, we do have setups coming up for this week. So, Mary Ellen, I know you have graciously accepted Erin's
the challenge.
Yes, the challenge. What do you have for us this week?
Well, I have a couple of stocks that caught my eye last week, and I am hoping I can. Okay, I'm going to share my. Okay, so what I wanted to start out with, the first stock that I'm going to be looking at is a very large pharmaceutical company, and it is a mystery stock. No, it is Pfizer, PFE. And the reason I'm pointing this stock out, it caught my eye last week, is certainly healthcare has been in an uptrend, but it's not every area is participating recently. A lot of the recently strong medical products stocks are starting to come under a little bit of distribution. But what we have seen here recently within healthcare are these larger pharmaceutical companies that are really coming on strong. So we're looking at Pfizer here, and pardon me, this is a company that they are due to report on Thursday. So I need to put that out there for those of you that are more inclined to wait until after earnings. But let's take a look at another stock that's in the group, and this is Eli Lilly. This company reported last week. They surged 8% on their earnings. I like to see what's going on elsewhere in the group to get a feel as we go into earnings, what we are seeing. AstraZeneca, AZN also came out with numbers and had a 3% advance and is up again this week. But moving back to Pfizer, and I want to talk about why these bigger pharmas are coming in with stronger numbers. And a lot of it has to do with the fact that with the new Trump healthcare initiatives, the red tape as far as getting drugs to market has been reduced. So that's really benefiting these companies as they go to clinical trials and as they push their drugs through their pipeline. It is advancing faster. So that is one reason that is very good news for these companies. But Pfizer in particular, analysts are raising estimates going into earnings later this week. And that tends to be a very bullish signal. If analysts are raising estimates going into earnings, it's quite positive. But Pfizer has they're looking to win approval for up to 15 new drugs. Now, it's not going to be immediate. It is going to be over the next 5 years, but they have a very robust pipeline as far as drugs coming up for approval. And then they also have existing drugs with blockbuster sales. So in addition, they have big winners. There's an anticoagulant and a cancer drug, and both of these drugs rank in the top 5 of drugs that are poised to have the fastest growth. So that's the backdrop fundamentally. let's go ahead and take a look at the chart technically, and you can see that Pfizer is poised to break out of this base, and it is, let me just see if I can quickly pull up the already marked up chart. And yeah, so it's poised to break out of a 6-month base here. And what I like is that the RSI, this is a weekly chart, the RSI is trending positively, as is the MACD. So that was the first one that I did want to mention in line with a group move, but more company specific. There are a lot of interesting things going on. Now, I will point out one other item though with Pfizer that is important to note, particularly because we're going into earnings. This company, unfortunately, if we just go back the last 2 quarters, it does have a history of getting ahead of itself. And when the earnings are finally reported, now the stock does not tend to do really great. So I do want you to bear that in mind. So keeping that in the back of your mind as they are due to report. But let's take a look at another stock that caught my eye last week. And this, of course, is Advanced Micro Devices. And for anyone that was watching the washout in a lot of the technology stocks, you may have noticed that here was one that was able to buck the trend, so to speak. And the company reported earnings that were absolutely stellar. They were their best earnings in 7 years. And so here we see this gap up on their earnings report. And the other thing is that the stock, as you may recall, on Friday, technology, Tom pointed out the NASDAQ got hit. It was down 1.5%. But here is Friday's action, and the stock actually withstood those market pressures and was able to eke out a gain. And the reason for that gain is a reason that will continue to sustain this stock and help it advance even further. And that is Intel came out with their numbers. And during Intel's earnings call, they talked about product delays, and in particular, their 10 nanometer chip. And this is something that AMD also produces. So Intel's inability and their delay is really going to benefit AMD, so they can step in and improve their chip sales. So for 2018, Applied Micro Devices is on track for 334% earnings improvement over last year. Now, this is an $18 billion company, so to have that kind of growth prospects ahead of them is tremendous. And so they did beat on both earnings and sales. One of the reasons for the boost in their chip sales is because there's been an unusual, I found this unusual, there's an unusual demand for personal computers. Personal computer sales have skyrocketed of late. And this is something the company did not expect, but they are thrilled about because they provide components for these personal computers. And a lot of it has to do with these personal computers, the gaming side of things, and they've also been upgrading the capabilities within these personal computers. So people similar to needing to have the latest iPhone, they want the latest personal computer. So that's helping to drive sales with AMD as well. So in essence, this is a stock that looks poised to go higher. Lastly, one item I really like about this stock is they have a wonderful female CEO. Thought that I would throw that in there. So let's move on to another stock. And this is a company that actually reported about 2.5 weeks ago. This is JP Morgan Chase. And they are the largest of the money center banks. But the stock continues to climb. This is their earnings report here. And you can see how the stock is continuing to advance. And we did talk about earlier that the financial sector is doing well, so it could be in line with that. But I will tell you that JPM has presented and shown itself to be the leader within these big money center banks. It's now hitting a new high, and there are a number of reasons for that. These big money center banks, they do trade differently than the smaller regional banks. They have other avenues of revenue. So for JPM, it's their trading revenue jump. They're the number one global investment banking, so the fee generation there. And then they've also increased their loan portfolio and their assets under management, which is now up to 2 trillion, actually, 2 trillion. So this is one that looks good. I like it. It looks poised to trade higher. And then are we running out of time?
Well, yeah, but I wanted to comment here. Do you follow Wyckoff?
I don't closely, but I'm certainly familiar. Yes.
Okay, because I know, well, Bruce Fraser, who's on the show quite a bit, we were talking about this one in particular. And so when you get in these sideways consolidations like JP Morgan had been in since the February high, he talks about these accumulation phases, which it appears that JP Morgan was in. And that low that we saw in late June, early July, where we took out those prior lows going back the last several months, Bruce was saying that could serve or appeared to serve as a spring.
Yes.
All refers to as a spring where you break down, looks like things are bad, and that allows more accumulation and then a spring back to the upside. I mean, I don't know. I'm not that familiar with but
it's definitely a phenom, and we have seen it again and again. This is Bank of America. They're very similar look, if you will, and it is something that is it's working. I mean, Goldman, they're trying. It's not as attractive, but I would argue that JPM is the clear-cut leader in this space. And you're right. Yeah, that sell-off has served a number of financial institutions. Last week, it was insurance stocks that are popping. Very similar phenom where they peaked back here and then sold off. They're coming in with good numbers with the higher interest rate environment. So it's another area that's benefiting.
Okay, so which of these stocks is your pick for the week? I wasn't quite sure.
Oh, wait. Oh, I just had, okay. Did I run out of time? Because here's my pick for the week, and we don't have to get into it. It's Target. They reported earnings a while ago, but analysts are continuing to raise estimates, and they have gone into overdrive as far as working out the kinks so that they can compete with Amazon. And yeah, I don't need to go further into it, except that it is breaking out of a base here.
All right. So well, I like Target, and 80.41 is the current price. So now you're on the hook. The good news is if it doesn't do well, you won't be here next Monday to have to do it.
That's right. I can just look the other way.
Yeah, but if you have a great week, you'll be like Aaron, you won't be here to enjoy it. And so it looks like a good chart. And just so everybody knows too, I mean, you're a momentum trader. You like to get that momentum.
You're right. You're absolutely right. I like to see those money flows coming in, the stock either at or approaching a new high, breaking out of a base. Actually, So definitely, although periodically I have a lot that I went through in my show this morning where they are those turnaround type of names similar to what we were pointing out earlier. So it's not entirely up and away, but yes, most definitely most of the time.
Okay, well, I'm going to go ahead and go with a different stock, obviously. I'm going to go with GATX Corp. This is in the commercial vehicles area. The stock had an awesome earnings report last week. The thing that's kind of enticing to me, number one, the stock was up over $90 last week. It's pulled back. It's currently at 82.05, so we'll go with that price. Gap support is the initial key support that I was looking for. I think also this $80 level, you can see the 20-day moving average. Also the reaction low after the earnings report was out. Stock had gapped up around 81 and change, came back down to about 80 and then took off. Went up about $10 in 2 days. A lot of demand right from $80. So I'm thinking as it gets closer to 80, I like the reward to risk here. I would not be shocked. I mean, sometimes these go a little further than you think to the downside. Does have the bottom of gap support down around 77, 77 and a half. So I would consider this as like an accumulation zone. But what I am looking for initially is a bounce off of this area. So I'm going to go with GATX. If you look down here at the commercial vehicles area, you can see that the stocks its peer group has been downtrending quite a bit, and yet you see GATX at a much higher level. So on a relative basis, you can see GATX absolutely just swamping its peers. It has pulled back with this selling, but again, I think you're getting close to a key support level where I wouldn't be surprised to see the relative strength begin to pick up again. So for the contest, I'll go with GATX at 82.05. And let me give you a couple of other stocks that I like here. Citrix Systems. This is another one that's working its way back down toward gap support and the rising 20-day moving average. Another great earnings report here with Citrix. Very heavy volume. You can see that it's in the software space, which is a strong area of the market that is currently pulling back. So I think that's bringing Citrix back down with it. But I think as we get closer and closer to that gap support level, the reward to risk really turns in its favor. Qualcomm, which I mentioned last week, I own this one. Stock has been pulling back a little bit since its earnings. In addition to smoking the revenue and EPS estimates, they announced a $30 billion stock repurchase agreement. The company's market value is a little over $90 billion. So about 1/3 of their company, they're going to buy back. They're going to buy back their own shares. So you're going to have a lot of buyers down the road for sure in Qualcomm. And then let me see, maybe one or two others. Let's see, Chipotle, CMG. CMG, a nice breakout with earnings. It's pulling back. This is another one. I think it's in this gap support area. I'm not looking for it to go much below the 20-day moving average if it gets down that far. You can see that restaurants and bars have not been performing well. This is one I think that Dan Russo from Chaikin Analytics talked about with me. And he mentioned that Mark Chaikin had really grown fond of CMG relative to other areas of the restaurants like Starbucks and so forth. And you can see on a relative chart that CMG is continuing to perform very well relative to its peers. And it is trying to break out again with its recent earnings report. And then the last one that I have, I think I mentioned this one last week, which is SWK, Stanley Black & Decker. I think it's broken the downtrend. I think that this channel that it was into the downside broke with earnings, big gap up, filled the gap, hit the 20-day, and now moving higher again. We've got a little bit of overhead resistance that we definitely need to negotiate, 148, 148.5. But if this stock pulls back, especially anywhere close to that rising 20-day moving average, I'm a fan of SWK. So that is it. Those are the stocks that we have for this week. You can see our setups. We got Mary Ellen's picks for this week. Like I said earlier, she graciously accepted the challenge. Of course, if I pick like I did last week, it won't be much of a challenge. But Mary Ellen went with Target at $80.41. I went with GATX Corp, 82.05. And there are some of the other additional stocks that we had discussed as well. Okay, so that wraps up the Monday setups. I know we've got our next segment, which is Earnings Spotlight. We're going to do something a little different here, Mary Ellen. Normally we do twice a month. I get my former partner of mine, John Hopkins from Earnings Beats, and he comes on and talks a little bit about some of the key reports that have just occurred or maybe that are coming up, and we look at a lot of charts. But I always look at earnings. I mean, I keep a strong earnings chart list. And so I look at what's going on with earnings. I look at what's going on with individual stocks within the earnings or within the within various sectors and so forth. So the first one I want you to look at is CNC. This is a company that recently reported its revenues, $14.18 billion. The market looking at $13.88. So an easy beat on the top line. $1.80 versus $1.76 on the bottom line. They raised their guidance for earnings per share for 2018. And so take a look at this stock. What do you think about CNC?
Yeah, I can see that the stock did drop on earnings, but it's worth noting that this company is it's called Cadence Design Software. So it is a software stock, and we are seeing this phenomenon where these companies, these software companies that traded up and got a little ahead of themselves, priced for perfection. So the stock, even though it came in with good numbers, it drops. So what we are seeing here is a very orderly consolidation. I would look for a pullback potentially to the top of this prior base, which would take you to about 125. So it could even drop down to this 50-day simple moving average, but it is all with an eye toward reversing and getting back its uptrend. So I think you're fine here. It may drop a little further. Because you do want to pay attention to, you can see the MACD is currently trending downward, as is the RSI. So give it a little more time here, and it should reignite its advance, provided, of course, these software stocks can gain favor again among investors.
Actually, Mary Ellen, I didn't mean to cut you off, but CDNS was the software. The CNC, I think this is the healthcare provider. But I will say the charts look pretty similar.
That's funny.
Okay.
Well, we can certainly take the same approach as far as technically and what to look for, because a lot of times these stocks will have these drops, and ideally, if they can come back to the top of their prior base. And CNC is actually another area that is coming under some distribution as well.
Yeah, actually, both of these charts, I mean, they do kind of remind me of one another. Both the groups, the software and the healthcare providers, higher, and both the stocks have been doing the same. But this, to me, both of these stocks are like a poster child for the old Wall Street adage, buy on rumor, sell on the news. Because both of these stocks had huge run-ups heading into earnings. I mean, this wasn't a surprise when these companies came out. And by the way, CDNS beat on their top line. They beat on their bottom line 45 cents versus 40. And they also guided their fiscal year 2018 EPS higher. So both of these companies, and this is the way the market works. A lot of people, I don't think, get this, because they look at the earnings, they see these stocks coming down. They're like, what? Why? Well, the reason is that Wall Street goes out and they visit these companies. They send analysts. Goldman Sachs sends analysts out there. They know, I mean, they don't have the numbers. That would be insider information, but they have a general sense of whether or not these companies are going to report better than expected or not. So a lot of times you get these companies that are moving up, anticipating these strong earnings, and then the news comes out and all you have are sellers. And so we've seen it on both of them. I actually like both of these companies. I like companies that beat top line, beat bottom line, have been rising into earnings. I love them when they pull back, and I look for reversals. I don't know whether or not that fits in your trading strategy.
Yeah. Well, I would argue that this earnings season is unique in that sense that the stocks clearly have gotten ahead of themselves. Q1, we had a number of stocks that came in ahead of estimates, and they were handsomely rewarded. I think the average percent gain from all of the S&P companies that beat was about 4%. So of course, now since then, during the second quarter, a lot of stocks the stronger stocks have been running, so we're getting a little bit of a different response. But more importantly, yes, earnings beats are good historically for companies, so we can expect these stocks to resume their uptrends.
All right, well, I got another one for you here. This is a little bit different because, first of all, it's in the machinery or industrial machinery space, which has not been performing very well last few months, although it has turned up in July. But the company is Crane Company, CR, and they beat top line quite a bit, 851 million versus 837, and also beat on the bottom line, 141 versus 135. They raised their EPS guidance for the year, just as the last two we talked about, and they have been, they did move up into earnings, but when you look at their chart, they did struggle off of the high we saw back in January. What do you think of Crane here?
Yeah, I think I like it. I like the fact that it has been able to break back up above. This green line for me is the 10-day simple moving average. I tend to use that because faster moving stocks do trend better with that. And then the red line is the 50-day simple moving average. And then the 200-day is the blue line. So the fact that it's able to break back above that is quite constructive. It's happening on volume, another constructive component. When you have your shorter term key moving average breaking up through a longer term, that's your golden cross. So we have another phenomenon. But what's going to eventually happen here as the stock, even if it sits here or if it were to advance further, it will eventually pull these longer term simple moving averages up, which is what you want to see. You want your stock to be going higher with the backdrop of a longer term simple moving average, because that's going to be your real trend, the 50-day. So right now we are very positively leveling off with an eye toward eventually going a bit higher. And I was going to pull up the weekly to get maybe just a little more insight on this one. But you can see the very same phenomenon, and the MACD is just breaking, it's just crossing positively on the signal side, poised to break up above that net zero. So this one looks compelling.
Okay, awesome. All right, let's take a look. I'm going to go with a smaller, I think this is a healthcare company, Merit Medical, MMSI. Another company that beat easily on the bottom line, 225 million versus 214 million, or on the top line, I should say. Bottom line, 43 cents versus 40, and they raised their revenue guidance with their latest results. What do you see with MMSI?
Now, interesting. I would presume this was their release date on the earnings.
Yeah. And there's one more piece of news you need to be aware of too.
Mm-hmm.
They announced 2 days after that, or maybe the next day, that they were going to have a secondary offering, and they priced it at 54.
Okay. So that could be create a heaviness there. So what we are looking at here is a phenomenon that we spoke about earlier, where these really recently strong areas of the market and underlying stocks within those groups that have had these run-ups are, even though the companies are coming in with good estimates, they are not necessarily being handsomely rewarded. But what I would pay attention to here on the short side is you do have that RSI trending negatively now, and really looking at this volume. This is 3 days ago. This is exceptional volume when you compare it, just looking back over historically. We're looking at a daily price chart. So when I see a stock trending and breaking below that shorter term 10-day simple moving average on big volume, it is worth noting. But I would make sure and keep an eye on this, make sure that it is able to retain and find support at that upward trending 50-day simple moving average. That's going to be critical. And then, of course, we can always take a little bit of a longer look at this, and it's going to look more positive in the sense that this green is your 50-day simple moving average. So currently it is finding support. Your RSI is still in a positive area. So generally the stock still looks fine. If you own it, you can stay with it, but you do want to make sure that it's able to retain that support here at that 50-day.
Okay, one more here. This one's hitting a major area of support in 2018, but this is Polaris Industries, PII. They beat on their top line, 1.5 billion versus 1.45 billion. They beat on their bottom line, 177 versus a $1.61. They've raised their revenue guidance. They've raised their EPS guidance, and the stock has been hammered to the downside. What do you see technically? I mean, do you buy at price support, or do you need to see strength?
Yeah, this I would not just walk, I would run away from. And the reasons there are twofold. One is it did break. I like to see, this is key support. So for my work, I like to see these moving averages in an uptrend. I like to see a stock finding support at either of these. However, now once this starts trending downward, we now have a very heavy pattern where the stock's ability to make progress is going to be dampened. And sure enough, it's breaking down, but take a look at that volume. So what that's telling me is when I see a stock break below what I call key support, that's your simple moving average. When it does so on super tremendous volume, that is an institutional footprint. It's telling you that the big guns want out. And oftentimes it's not just going to be over a 1-day period. It's going to take them at least several days to exit. And it's similar to back here when we saw this drop on huge volume. And you can see how the stock continued to deteriorate as again, that big money was exiting. So you have your RSI. Now it is deeply oversold, but even if we found the stock leveling off and potentially trying to turn, because at some point, similarly, when stocks get too high, they get overdone to the upside. You may see a little bit of some bouncing around here because it's so extended to the downside below these simple moving averages. But overall, the stock is now broken your shorter term key moving average down the death cross through the longer term. So this would not interest me.
Okay. All right. I got one more, and this time we're going to take a look at a negative stock. This is Owens Corning, OC. This is a company that missed on their top line, 1.82 billion versus 1.86 billion. They fell way short on their estimates, a $1.17 versus a $1.45 on the bottom line. And I mean, looking at the chart, I don't know how much you follow, gaps and like
Sure. Yeah.
gaps, but the volume that this stock had on its last earnings report just a few days ago, I mean, if you look at that volume, it's just massive, and we've been coming up off of that. Do you think this could be an exhaustion gap, or is this one that you, again, would just leave alone?
Well, yeah, this is what I had mentioned to you, that a lot of times either gaps up or down. Oftentimes you will see a filling of that gap, which is what we are experiencing now. So you can see the stock, it's hard to tell, but it really, the tail here, it really did sell off tremendously. So you are seeing buyers coming in anticipation that it got overdone to the downside. But from my work, as I mentioned before, you have far too much in the way of heaviness. You have these simple moving averages trending downward. And from my work, that then becomes resistance as the stock attempts to rally. So this type of stock would not capture my attention until it was able to break back above these simple moving averages, resume its potential uptrend, but it's going to take time. Really, this would not, from my work, would not be of interest. Now, over here, this would be interesting to me. This is probably earnings related. It gaps up. It's got the key moving averages all in an uptrend, ready to support it as it continues to advance.
Yep. One thing I wanted to point out there, back in mid-April, exactly what you were talking about, where the price action moved right up to the moving average right near.
Right. It's classic.
Yep. And then fell again from there.
You bet. You bet.
Now, from a hierarchy standpoint, I mean, you've got triple top at about 68 or 67, I guess. Back to May, June, and July, you see those three tops in the last 3 months going across there. Now, if you break back, and this is just a theoretical question, just to talk a little bit about your strategy. But if you get back up above the moving average, does it not bother you that you still have that overhead resistance? Would you need to see both, or would you just be interested in getting back through the moving averages?
Well, no, I think the position of the stock or the moving averages now is that if it were to get up above it, it would get up above the prior pricing here. But yes, you do need to, of course, pay attention to overhead supply. And that's why from my work, you generally, when a stock is hitting a new high, it's a 1-year high in price, because you don't have that overhead supply. Potential buyers that have been waiting for the stock to get back to where they bought it so that they can exit it. So yeah, there's a lot of noise going on here.
Okay, well, that concludes our earnings spotlight. We did go through, I don't know, a handful of stocks there. It is interesting. I mean, that's one of the things that I really enjoy about the market is, well, first thing I really enjoy is that the market's always changing. Just when you think you got something figured out, everything changes again the next day and you got to refigure it out. But with earnings, I mean, you can see how the character on some of these charts in literally one day, leading up to earnings, it's in this straight uptrend. Everything seems perfect. And then the stock comes out with great numbers, and all of a sudden you're trying to figure out where the bottom is on some of these stocks.
Yeah.
And that doesn't make sense to people who don't understand how the market works, because from a common sense perspective, if a company comes out with great numbers, better than expected, it should go higher, shouldn't it?
Right.
Not always.
And then there are, of course, nuances as well, where different industry groupings pay attention to different metrics. So if you're looking at a McDonald's or a fast food, it's going to be same store sales all day long. Earnings, that's interesting. But not same store sales is going to be the driver there. And then a lot of the tech stocks, it's profit margins. And then, of course, Netflix, it's subscribers. And same with Twitter, it's going to be subscribers. Okay, the earnings look great, but what about your subscriber base? And that's why these software stocks are getting hit, because the subscriber base, certainly with Twitter, a lot of these software stocks, of course, are driven by the number of subscribers. And there's a fear that they may see a diminishing there.
Yep. Another great point too would be like with some of the pharmas and the biotechs, a lot of times it's about their drugs in the pipeline, and the FDA is about earning. So very good points. Okay, well, let's go ahead and wrap up. We're going to move on to the 10 in 10. We're going to do things a little bit different today since Aaron's not with us. I do have 10 stocks that I have already selected, and the first one is Take-Two Interactive. So let's jump into this one. And at the end, maybe if we have a minute or so, Mary Ellen, I'm going to ask you if any of these stocks are appealing to you. But first, let's look at Take-Two. And here we have a stock that has been, let me go ahead and annotate it, been uptrending for quite some time. Last 3 or 4 months, been really nice. But this is an ugly candle today on Take Two, and the volume is expanding. I'm assuming it has something to do with earnings, but I don't know that. I haven't confirmed it. I would just be watching at this point the next two key areas of support. Going to be that low at the end of June right here, and then again the low back in May. I think those are two key areas. If we happen to go down and trade beneath both of them and come back up and close above both of them, that might be a short-term bottom that we see. But otherwise, I'd be careful, especially if we close below that 110 level. So Take Two is not one that I would be overly optimistic about today right now. But let's look later in the day and see how it finishes. Next up is Netflix. We talked about Netflix a little bit earlier. I would be watching. I didn't annotate it earlier, so let's annotate it now. But there was your open after earnings. You see the heavy volume? This is where the stock opened after the subscription shortfall that Mary Ellen was just talking about. The stock recovered. And I remember speculating on the air, okay, can we get back through this prior short-term support that turns resistance on the gap down? And no, we couldn't. So right there, we gapped down, we came back up, tested the prior support, failed, went back down. And now are we breaking down, or are we going to reverse into the close? I think this is a really big, important question that we need answered this afternoon on Netflix. If it fails, if we close like this with 20 million shares, I think we go lower on Netflix. If we can reverse after moving lower than the earnings and come back up and close, say above 346, 347, put in a hammer, then perhaps in the short term we put in a bottom, maybe make another run for the 20-day moving average. So I got some mixed feelings on Netflix as well, but let's see how we close today. That'll give me more answers, I think, than I currently have on this one. Next up is Bank of America. Talked about JP Morgan earlier. Let's take a look at Bank of America. Very similar spring action after breaking down. I'm going to go out a little bit further here. Let's take a look at a one-year chart so you can see the lows back in January and see what I think is a pretty critical area of support on Bank of America. Here were your tops back in, was that October and November? Here was gap support on the November jump. And notice we came right back to that before turning higher. But the spring action to me is right in here. You can see that we had multiple tests. Maybe we could drag it down just a little bit further. Here was a low over here, about 28.50. And look at all these tests down around 28.50. We went down to 27.50. Looked like we were breaking down, but instead we've kind of got that same spring action that we talked about earlier with JP Morgan. I think Bank of America looks good, although now we've got some issues overhead to deal with. And you can see we're already off of the earlier high today after what looked like a breakout above the May high. This could be a short-term top where maybe we need to look back to the 20-day moving average if the banks pull back here. So I like Bank of America. I like the banks. I think the 10-year Treasury yield goes higher, and so I think these stocks will do well. But short-term, I'm not so sure with the issues that we have here in the very near term with the candle, the way it's developing so far today. Micron, MU. Well, we got a double top in play. Haven't been able to get through that. So that clearly stands out here for me. There's the double top. Got up to about 63, 64 back in March. Hit that again in late May, continuing to move lower. I would just say at this point, I'd watch maybe a trend line. If you just take the most recent lows right here, I think it's pretty clear that we are sitting just about on that trend line. So if we fail to hold the most recent price support from earlier this month, which is around 51, just keep in mind, if we lose this 51 level, which is this price support, we're also clearly breaking this trend line. So big volume decline below 51, I'd be careful of with Micron. All right, what do we got next? Next up would be Zynga, ZNGA. Zynga, another one that is breaking down today on heavy volume. Another one maybe it reported earnings earlier today. I'm not sure. I didn't see this one if it did, but pretty clearly key resistance back in March where we topped out there as we went through that level, broke above 395 in May. Check out the volume that came in to support this move. Came all the way back down, tested that price support level. I would have expected a bounce. We got it. But now we are either breaking down or we are setting a bottom. Another one.
And just a side note, that one is due to report on Wednesday, and it
Oh,
is in that software gaming space.
okay.
So getting hit with the market.
Yeah, maybe some of the fallout from what was that first one I did? Take-Two Interactive, maybe.
That's right.
Yep. Okay, so let's see how it closes. But again, this is one that not only could potentially reverse here, but as Mary Ellen just mentioned astutely, they do have upcoming earnings. So it was not today; it's coming up. So be careful there. All right, next up is OPHC. Not even sure which one this is, but I think it may have been a scooter mover today. No, actually, this one's hardly traded anything. Let me just look at it from a longer term perspective. Optimum Bank Holdings. I tell you what, I'm going to skip this one. This is just not much trading volume, and I don't think it's worthwhile. Let's go on to American Express. I think they trade a little bit more. Yeah, let's stretch this out too. Been trading in a range, but it is in the financial space, which is beginning to strengthen again. But remember all those false breakdowns we talked about? JP Morgan, Bank of America. Is this a false breakout that we just saw on American Express? Could this be some sort of distribution? Don't know, but definitely worth considering.
A side note with American Express, one of their areas of growth that set them up for success this recent earnings is that they are competing directly with PayPal and really coming on strong with global payment options. And if you look at PayPal today, that stock's down 4% following a 4% drop on Friday.
Wow. Yeah. Maybe setting up an opportunity, maybe not. But here you see AXP did have a breakout on Friday, and it has pulled back. I would watch a couple key levels to the downside. Well, first, with the PPO rising the way it has, you can see the last time we pulled back, we held the 20-day. So if we hold the 20-day from a very short-term perspective, that would be bullish, especially if we could move back up and get another breakout. But if that fails, if the 20-day fails, I think you've got your trend line support that comes in down below $100, and then two bottoms, very key bottoms, down just below $96. So those are at least a couple of areas that I would certainly be watching closely as we move forward. And no doubt that one will be one that's closely watched as we go throughout this week. Splunk, SPLK, one of my favorite names in the market. I just feel like it should be splat. And it might be if it breaks down below 95 today, because it's got gap support and a couple recent bottoms and another one that potentially is looking to break down. See the heavy volume early March? We gapped up from about 94 bucks, came back down. Look at these tests right here on this line, and we are not on light volume today. We've already traded 1.7 million shares, so we're on pace probably to be somewhere around 3 to 3.5 million shares today. And if we break, this could be a head and shoulder top. Left shoulder, neckline, head, neckline, right shoulder. This could measure down quite a bit. So with the volume coming in, I think this is a real key area on Splunk to watch today.
This has been a weaker name in software. I'm familiar with it because we had it on our buy list with my newsletter, but you can see where it broke that not only the 20, but then the 50-day simple moving average. And once it breaks that 50-day, all bets are off. We immediately removed it. And since then, it has not recovered. And it did present its hand originally as one of the first software stocks to show weakness. So that's not a good sign.
Yep, and right here you can see this prior support when it did fall here on the heavier volume. Note that volume too.
That's right.
It broke down below support on heavy volume, and when it rallied, it went right up to that prior price support, which turns resistance and is now turning back down. So volume picking up and a breakdown here, I think would just add to some of the misery of Splunk over the last 6-7 weeks. Okay, let's take a look at Guidewire. I think this is another one in the software space. I don't know if you're familiar with this one, Mary Ellen.
No.
But I think this is another one that is, it seems like a lot of these stocks are at key support areas. I mean, we've had multiple tests now. When you look back, this was a high back in late April, right around 87 bucks. We've come back twice to test 87 and hold. Currently 85.61. Volume's not off the charts, but I wouldn't say it's light. It's about, on pace maybe for about 700,000 shares today. So maybe it is just average. But
and if you look at that break in June, that big break below those key moving averages, that was on earnings. And the company actually in the beginning, where you could see the big volume pickup, the company came in with negative earnings and only single-digit prospects for growth this year. So it was surprising that it even rallied and made it back to its prior highs. But you can see where it's catching up, the weak earnings and the weak outlook, and the group under distribution all catching up to it.
Yep, no doubt. Let's see, we've got a couple more here. Let's take a look at the pharma space, Teva Pharmaceuticals, TEVA. This is one that seems to be just consolidating sideways. Nice volume picking up here in May and June as we were rallying. Let me draw a couple of trend lines or support lines. I would say right here, top, and then another top sideways, and then we break out on increasing volume here in the second week of June. Notice recent weakness came down just about to this support area and the 50-day moving average that Mary Ellen's been talking about a lot today, and it's trying to turn higher. So I think right now, I think it's in a trading range. Does it hold $22? Does it break out above $25? Which way does it move first? Do you see anything on this one?
And this has some other backwinds behind it. It is due to report on Thursday, and analysts are raising estimates for both this year and next going into earnings. We talked about that being positive, and the pharmaceutical space in general is constructive as far as the backdrop and the dynamics.
Okay, cool. And the last one I have is the IBB, which is the iShares for the biotechs. We had been on quite a roll in May, June, and July. The IBB was on a roll, but it is not on a roll right now. So let's take a look at a couple of key areas maybe to watch for a reversal. I think clearly we gapped up. I think there's a gap support zone between about 112 and just under 114. Today's low was the 113.90. Stock, this ETF was up at 120 just a week ago, and now moving down below 114 is an opportunity. I don't know. I kind of like the biotechs, but on the pullback, I think I would not be interested if we lose gap support down at 112-ish. So this would be an accumulation zone for me as a short-term trader looking for a target up near 120. I'd want to keep that tight, that stop fairly tight.
And really with this, you do need to pay attention to some of the bigger components within that, and Biogen is one. It did have that big gap up, but it's really behaving poorly here recently. So something to keep in mind.
Yep, and it is breaking back below the lows after the huge gap up we saw earlier in July. So a reversal today would be good news for Biogen and maybe for that IBB as well. But if it continues to trend lower, I agree. That's going to certainly keep some pressure on the IBB. Okay, and that is your 10 in 10 for today. So let's take a look at what we just talked about. You can see the list right there. Some great stocks. Really appreciate your input, Mary Ellen. And we're going to go ahead and take a break. And when we come back, we will get you the next market update. Be right back.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
Okay, welcome back, everybody. And let's take a quick look and see what the market's doing. You can see the Dow Jones Industrial Average now down 118 points. The S&P 500 down 18 points. The NASDAQ down 115 points. It's been a pretty remarkable week since the highs that we saw last Wednesday, closing above 7,900. Seems like we're going down 100 points at a time here. Russell 2000 also under pressure again today, although on a relative basis holding up a bit better. Still down 6 points. 10-year Treasury yield up about 1 basis point, about where we were when we started the show, 2.97%. Volatility is picking up. The VIX now up 10%. The XLE Energy still leading the market, up about 0.75%. Technology definitely is the one that's taking it on the chin today. Facebook continues to be under pressure, as is Electronic Arts. Adobe, look at software really getting hit. Adobe down 5% today, big down day. And Netflix, as we've talked about many times already today, down quite a bit, down 5.5% as well. Okay, I don't know. What do you kind of feel, Mary Ellen, for the overall market right now? I mean, are Are you bullish? Are you bearish? Are you just a little cautious because the summer?
Oh my gosh. Yeah, that's a great question. Certainly cautious, and even more today when you see that NASDAQ break below that 50-day simple moving average, that is going to raise some flags. And so from here, we're at a 76.12 level on the NASDAQ. So the next level or area of support would take us back to those June lows, 74.20-ish. And it's not what you want to see, because when you have a group such as the NASDAQ that was leading the markets, really charging to new highs, and a lot of it was because of the underlying growth stocks all having great numbers and all advancing with that, it is not good for the health of the broader markets. You want those leadership names and the leadership groupings to remain intact. And so definitely a cautious air there. As I've said over the weekend with my report, there are pockets of strength that you can play. There is energy. There are some of these bigger pharmas. But when you have a major component of the bullish markets coming under such selling pressure, it's not healthy. It's not what you want to see. So, yeah.
Yeah, I was just going to say, I was pulled up this trend line, and I thought that, you know, I just point this out because if you go back to the April low, just the short-term uptrend that we've been in, it's really almost a channel. Let me see if this kind of fits into the channel. Yeah, I mean, it's pretty tight channel that it's been in. If you just take the highs and connect them, and then also the lows. So while it looks like potentially we could be breaking down, I mean, we've seen tails that go down below intraday lows. That's what I mean when I say tails, or these wicks from the candlestick, shadows, whatever you want to call them. But as we rebound, we've established lows. Now, I'm not saying that's what's going to happen, but from a trend line perspective or from a channel perspective, if we do finish strong today, I think it would begin to make an argument that maybe this 3-day sell-off that we've seen in the NASDAQ may be short-lived. But do you have any thoughts on that?
Well, when you look at the heavyweights within the NASDAQ and you're looking at a Google, which had great numbers, it initially rallied off of that. It's down probably about 2.5% today. Facebook's getting hammered again, down another 4%. So when you look at some of these indices, it helps to pay attention to their bigger names, and they are just really showing their hand as far as the sellers coming in. And the fact that it's not discriminatory, you're seeing a stock such as Adobe, solid grower, great company, getting whacked down 5%. That is really going to unnerve a lot of investors, I think. And so with that, you may see a spillover into other stocks, people that want to preserve what little or what profits they may have. And it could catapult further.
Yeah, I think some of them, I'm not a big Facebook fan. I said that last week, and I'll keep saying it. I don't, you know, what they reported was just a mess. They had just an absolutely awful report. Nobody knew it was coming. We're going to talk about that some more in our next segment. But when I look at a stock like Adobe, you know, you have periods like we saw back in April where we broke down below, say, the 20-day moving average. We did hold the 50-day moving average. But for me, we held on to that prior low, which I think was really important. And so when I look at it, yes, we're selling, the volume's picking up, but I still look at Adobe as a very strong stock. Got a couple of bottoms here in price around 235. I would begin to grow much more nervous if we lose these support levels. But I think as long as the price support holds, I know that you probably put a little bit more emphasis on the moving averages.
I do, yes.
You know, and here was an example where we went a little bit below the 50-day moving average, but we held on to that prior low. I don't know. I think as long as Adobe, which has been a strong performer, holds above 235, I think we see a bounce, because when the money comes back into the market, I look for strong areas like software, like Adobe. So I could see this one rebounding. So I haven't given up, but I understand exactly what you're saying when you.
Well, yeah, I just don't know that I would be a buyer here today. It's the volume right now is 118% above average for this time of day. So again, you're clearly seeing institutions voting with their selling, and I agree, it's a phenomenal company. There's no reason for it not to come back longer term, but I would like to see a little more leveling off before re-entering.
All right. Does it give you any more? And I know we're spending a lot of time here on Adobe, but does it help?
Well,
when you look at a long-term weekly chart, you see the 20-week moving average, which has been excellent entry points into Adobe for the past 2 years. And we're now trading at 241, and the 20-week moving average is at 237, along with that price support I was just pointing out, 235. It just seems like from a short-term trading perspective that the odds or the reward to risk is in favor of the longs until
right. I would point out, I'm looking at a weekly chart. It is breaking that 50 days we talked about, and historically, since 2016, it has not broken below that 50-day and then remained below it. It has done it, and then throughout the week been able to regain its footing. So we are still early in the week. It's Monday, and for my work, I do tend to wait until the end of the week before I make any decisions. Adobe is a name that's been on our list, so I would not make any rash decisions today. Again, just wait to see how things play out. And I do tend to use weekly charts more in my work. So,
okay, fair enough.
Yeah.
Well, let's go ahead and move on because we do have one more segment. We got a couple stocks I want to go through, but this segment is, are you buying this? And we haven't done this one in a while, but I always like it. This is a segment where I will make a technical argument about a group or about a stock. You know, maybe it's to buy, maybe it's to sell, maybe it's, I don't know. I'll make some kind of an argument. And I'm going to ask Mary Ellen if she's buying it, meaning is she buying my argument, and whether or not she agrees or disagrees, or she's
truth or dare.
Yeah, exactly. You're more than welcome to debate the merits of my claim. I'm sure there are a lot of folks out there listening that will debate them as well and will not agree. So don't feel bad if you don't agree with me. That's for sure. But let's take a look. Now, first, I'm going to go into the autos. And let me just pull up the auto chart here, which is the DJUSAU. And, you know, autos have been, you know, in the news a lot with all the trade talks and so forth. I know GM, when they came out with their earnings report, they issued some cautious statements because they were looking at higher commodity prices. You know, it's obviously going to run their costs up. But look at the auto industry here in the last 6-7 weeks. I mean, we're not talking about a little pullback. This is a group that was looking really good in the middle of June, 232 on the index. Now we're down at 193. I mean, this has been a 40-point drop, which is about maybe 17, 18% in a very short period of time. So they've been a mess. I look at something like Ford, and Ford has been a mess. Ford's been a mess going right down. I think they're near a 3-year low. I'm not going to pull up the long-term chart, but just trust me, they're near a 3-year low. Tesla was strong. I'm going to go back a little bit. Let's go a couple years back here. Tesla was pretty strong back in the first half of 2017. You can see right here, but since then, it's been a little bit of a jumbled mess, and they're trending lower. Then we got Chrysler or Fiat Chrysler. Whoops, wrong ticker symbol. FCAU. Fiat Chrysler was trending higher, and you could draw a trend line. That's been broken. We're beneath the moving averages that you like to follow, and, you know, continuing to trend lower. So it seems like, you know, their mojo has certainly disappeared. And then I look at GM, and GM, even though, you know, maybe you could say, well, it certainly hasn't performed well recently, did have a triple top. And just last month, it was trying to break out to a new high, and it's still been holding the recent lows. I think on a relative basis, GM looks pretty good. If I was going to be buying in the auto space, I would buy GM based on these charts. Are you buying this?
I am not buying this. And the reasons are, well, you can look at it technically and just see how that gap down. Again, I'm going to pay attention to the volume, huge volume, although it did find some support. Some buyers are in there. But let's take a look at the bigger picture with, for instance, GM. You talked about the tariff problems and then also the steel pricing being enormous. But GM actually came out and guided lower. Management came out and said, we're going to have some difficulties here. And the other key component is they have a raw material cost of $1 billion because of an increase in these raw material cost. That $1 billion headwind is really going to continue to make it difficult for them to meet any kind of profit margins. So I think from that picture, but also technically, the fact that you have your the RSI up at the top, and also I'm sorry, the RSI is down below, but the PPO, you're just getting a bit in the way of negative signals.
Mm-hmm.
Ideally, I would look to a scenario similar to the July-August, actually of is that 2017,
Yes.
where the stock price is able to, for instance, in the beginning of June, right there, of course, hindsight is 2020, but I use this kind of hindsight as a way to know what to look for. I'm looking for the stock to break back above those key simple moving averages. I want this PPO to head upward, as is the RSI. So using this as your guide on what to be on the lookout for as far as when this stock could become interesting.
Yeah. Well, I would just, again, I would take the other side of it, only because I do think it continues to hold its trend line support so far.
Mm-hmm.
And off of an uptrend, I think that the highs have been clearly established at 45. And I think the reaction lows here around 34.5, 35 present some great support. So with it trading more toward the lower end of the range of this consolidation off of an uptrend, I, tend to like to accumulate in, during pullbacks and during selling as you approach support.
Sure.
Which doesn't always match with everyone else's style, but that's my argument for it. And it is, I was speaking more relative to the other stocks in the group. And I know before we went on the air, you mentioned Toyota was doing pretty well.
Oh, TM is the ticker on that one. Yes. Toyota is a bit of an anomaly within that space, but they actually target a different community. And I believe they've just had an increase in car pricing.
Mm-hmm.
But that one is certainly, from my work, quite a bit more constructive looking.
Yeah, definitely in the short term. I'm not going to disagree at all.
Yeah.
But it is within the confines of a sideways consolidation. I mean, you could maybe draw lines here going up, lines coming down, maybe a squeezing symmetrical triangle, or you could just use a sideways rectangular consolidation. But it comes after an uptrend, which I think is very constructive, very bullish.
Well, if you want a real turnaround, you can look to companies that supply to these automakers and take a look at GT, which is Goodyear Tire. And I only stumbled on this because last week I was looking at subgroupings that were up, and the tire group was up some phenomenal amount.
I'm a little tired.
Early.
I'm a little tired of them going down. If you get my drift with that pun.
That butt-ump.
The drum roll.
Good play on words there.
Yeah, I know.
And is it bouncing, the tire?
Okay. There you go.
And on that note,
we're going to move on. All right, let's do one more, because I keep talking about, we're going to talk about Facebook. So I'm going to start my rant now. So if you're a Facebook fan, you might want to just turn your sound down. First of all, I'm a CPA, so my background is I audited companies, and from my experience looking back at companies, when they set Wall Street up for failure, like Facebook just did, I think it can be a long time before Wall Street trusts a management team again. Now, Facebook's a big company, very visible. Maybe they'll get a pass when all is said and done, but they look at how Facebook was trading going into its earnings report. I mean, it was going straight up. So clearly any analysts coming out and talking to Facebook were not getting wind of what they unleashed on the market last week when they missed their quarterly estimates for the first time in 14 quarters in terms of revenues. They lowered their quarterly revenues for quarter 3 and quarter 4. They lowered their operating margins and said that they were going to begin trending toward operating margins of 35%, mid-30s percentages. Wall Street consensus estimates was 45% and 44% the next 2 years. Now, if you know anything about valuing companies, you're basically valuing the future discounted cash flows of a company. And when they come up and say, oh, by the way, our operating margins, I know you said 45, but they're really 35. That is there's two problems. Number one is there's obviously an immediate valuation, which we saw in the earnings gap down. But I think there's also a management credibility issue at this point, that if I was an analyst going out and I'm not getting any wind of problems and they come out and unleash what they unleashed last week, it would take a while before I'd be interested in listening to what their projections are going forward. And so I'm going to make this bold statement. I think Facebook's going down to test this 150 level. I think we're going to bounce at that point, maybe get a little bit of a right shoulder. and I think Facebook breaks down and goes to 100. Now, that's a bold statement. Are you buying this?
Well, I agree with your assessment that trust among Wall Street is paramount when you're looking at stocks. And I would hear that quite a bit when I was meeting with analysts and portfolio managers. And one comment I heard once was, if you can't trust the CEO or the CFO to babysit your children, then that's a stock that you don't want to own. And so that is something that is going to take quite a bit in the way of time to recover.
Mm-hmm.
And based just on what we're seeing now over the last couple of days, the selling is not completed yet. This is a widely owned company within a lot of the top funds. And as we get into month end and accounting and so forth, I'm sure a lot of them are looking to shed some of their shares. And so that is only going to continue to depress the stock.
Yep, no doubt about it. All right, well, I'm done ranting now, but I don't know. That one really floored me. You know, we talk about, buy on rumor, sell on news, but that was crazy. That was obviously the rumor hadn't found its way to Wall Street because Facebook was continuing to move higher before that huge sell-off. But anyway, it's a fun segment. I enjoy, these segments where we can kind of have a little fun back and forth. But believe it or not, the show is just about to an end. Here's the two symbols that we looked at for Are You Buying This for this segment. It was fun. It was fun having you on. And it
was wonderful, Tom. Really great.
Yep.
Great insights.
Yep. Are you going to do a workshop tomorrow? Or I know we talked about maybe. I didn't know if you had talked.
I do have it on my schedule to do that. Yeah. Yeah.
Right. That's going to be a treat for everybody. Do you know what you're doing it on?
Haven't gotten that far. I was going to wait and see what gifts the market was going to bring to us today. And it's a bountiful basket full of gifts. So, but it will be relevant to the current market and, as always, insightful.
Yeah. Do you think this internet selling that we're seeing, do you think this is short-lived? Do you think this is just kind of a quick, I mean, I know Facebook, we just went over that and they've got some problems. But do you think Twitter really added to it to the point where a lot of these internet stocks now are under pressure to deliver?
Yeah, I think when you look at Friday, because Friday's market, it opened. The first 30 minutes, the market was up and everything looked quite rosy. But once Twitter came out with their numbers, that really seemed to shock and just really spread the disappointment and really fear, because that's what's driving selling. It's people that are fearful that the stock, of course, is going to go lower. So that when you see a company like Twitter, where their numbers came in, their earnings were great. It was just more the subscriber base. And as I talked about before, a lot of these enterprise software, these software companies, they're driven by that subscriber number as well, to an extent. And so a sense that even if these companies come in with great numbers, if they're not growing their client base, it's really going to whack the stock. So that brings in the fear. So as far as how long it will last, these are all great companies. A lot of these software companies that are getting hit. And you look at earnings, the IT, they're on track to just have the best earnings growth in over 8 years. So I believe that there will definitely be a resumption back into these stocks, but for the near term, it's a little touchy.
We can get back into it tomorrow. Definitely enjoyed having you on the show, and we'll definitely back through this tomorrow.
Likewise. Thank you very much.
I want to thank everybody for being with us. Please remember to complete the survey. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. We'll see you back here tomorrow. Happy trading.
See you tomorrow.